India's market news headquarters. Cutting-edge analysis. Influential insights. Market-moving intelligence. Broadcasting live from the CNBC-TV18 Motilal Oswal studios in Mumbai.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. The market is going to be in focus after, of course, what we woke up to yesterday. Is there going to be some recovery? Yesterday, it was not all bad. It might look like that if you just looked at the Nifty, but the broader market, once again, did not nearly as badly as what we thought. Well, this is, of course, another edition of Bazaar, and I'm Prashant. With me, my colleagues. Nigel Surabhi is back with us. A bit of a patchy throat still, Surabhi, but much better.
Recovering. But hey, guys, I had to come back. What did you guys do to the market this week while I was away? No, jokes apart. But I also had to come back because, all of us are trying to manage our, couple of days of leave here and there. So for the three of us together, it's our last Bazaar of 2024. And it's been a great ride, folks. So thank you for it.
Thank you for it, and thank you guys for it. And we just offer like
for a few, yeah, exactly. It's just a couple of days.
Bigger than
no, it's not. But yeah, I'm just trying to make it grand this Friday. So.
Yeah, that's right. It's a Friday. It's the last working day for me on 2024. It's been a great year.
Yeah, 2024.
Yeah, 2024.
So
yeah, let's get straight to the action, Prashant.
Absolutely. But guys, keep watching because if you're taking a holiday, happy holidays. But otherwise,
programming
here will of course be very much on. We're not signing off.
Not at all. We're just trying to feel happy
anyway,
this Friday.
So let's just quickly run you through what you need to know as we start another trading session this morning. So you got the S&P, which ended absolutely flat. The Nasdaq was flattish as well, and you got the Russell 2000, which was down 0.6%. So continuation, but very small cuts coming through after what we had the previous day. At the macro markets, look at the 10-year yield, another 5 basis point jump after the 10 the previous day. We are at about 4.56. Dollar index, another third of a percent. So about 1.2% the previous day, immediate post-FOMC reaction. And now we're at about nearly 108.5. This is the problem area, especially for emerging markets. Now, and by the way, data which came through last night out of the US kind of reaffirmed with the hawkish turn or whatever you want to call it, what the Fed did. Because lately data has all been strong and this was largely in line with the stronger data. So GDP numbers, initial jobless claims all beat expectations in that sense in a good way. Initial jobless claims were below, which is a good thing. Now, the risk of a US government shutdown, and we highlighted this yesterday morning as well, is rising. The deadline is tonight basically, 20th of December, midnight is the deadline. Last night, a Trump-backed plan to fund the government failed. So basically, Donald Trump and his sort of incoming vice president, they basically proposed that let's not have another vote on this in March. Let's have the vote now. Let's have the debate now. Let's pass this now. And let's not have a ceiling for another 2 years. Well, that got shot down. So we'll see. Unless and until today, there's something, they're able to come up with something, and this would typically need bipartisan support. It's likely that the government actually in the US shuts down. The actual economic impact is likely to be very limited, especially if the shutdown is brief. It largely affects, government employees are paid a little late. Economic data releases come out a little later. Largely that's about it. Unless and until, of course, it stretches, and that's not the base case at all. Just to come back and tie in the levels here. So as I said, yesterday the frontline indices saw damage, but then it was broader markets nearly not as bad. Even frontline indices, all you had was the first 45 minutes, 60 minutes of volatility, a big swoon and then a bit of a recovery, and then it just flatlined for the next many hours till all the way into close. Nothing happened after that. So the Nifty was able to defend 23,900, the level we put out yesterday, almost exactly there, and then bounced. Nifty Bank ending above 51,353. So intraday, the initial open was below this, and then we never sort of touched it again, ended comfortably above it. So these become the first very near-term sort of levels to watch. After that, support for the Nifty comes in at 23,675 to 23,775 zone. These are again very near term. Immediate hurdle, I mean, if you want to talk about the market starting to see some recovery and repair, 40 hourly exponential average is 24,300. 24,301 is the precise number. Bank Nifty resistance comes in at 52,010 and 52,525. And supports for the Nifty Bank will appear up on your screen. And that stands at yesterday's low, which is 51,263. As I said, very near-term levels that we're looking at here. GIFT Nifty should give you an indication how we're likely to start. At the margin, there is silver lining, which Surabhi Nigel will talk about. I mean, a big tech company, Accenture in the US, reporting a beat. So maybe there is some help. But otherwise, it's a 100-point lower start on the GIFT Nifty. Surabhi.
Again, my God, what a week it's been, right? But that's true, Prashant, because even, I mean, despite all of the attempts at a pullback, Wall Street indices did end at the day's low. They could not carry home gains despite that major slam dunk session in the previous day. So that's something that we have to take on board. Anyway, lots of central bank action. So let me start with what China has done. China, like the BOJ, has left interest rates unchanged. The 1 and 5 year loan prime rate, they remain where they were, 3.1% for the 1 year and about 3.6% for the 5 year. In Japan, however, watch this print carefully. Inflation is unrelenting in Japan. It's picked up. The November number, this is core inflation as they call it, is about 2.7%, which is much higher than October, slightly higher than estimates as well. Yesterday, the BOJ decided to stay on hold. It didn't sound hawkish either, despite the stickiness in inflation. And that's because the BOJ said it needs more time to also, parse over the policy announcements that will come in once Donald Trump takes office. Speaking of central bank action, the ECB again has stayed pat, did not change rates yesterday. And that has led to more volatility in the currency space. So I just want to focus on that. The dollar, after taking a bit of a pause in overnight US action, again, there's a tinge of green on the dollar index. It's again at near those 2-year highs, almost 108.50 now is what we're talking about. That continues to put more pressure on Asian currencies. The yen, which weakened substantially yesterday, it was down 1.5% yesterday. It continues to see downward pressure this morning as well. It's at the lowest level since July. Remember July when we had this whole yen carry trade, unwind, etc. play out. So we're not quite at that level, that lowest level yet, but we're very close to the July lows on the yen. For us, the rupee is going to be a big watch point. Remember, the weakness yesterday took our currency to finally break the 85 barrier. So will it stabilize? Will it pull back? Will there be central bank intervention? So currencies remain extremely important to watch. Now, for the Nifty, we are below the 20 DMA, the 50 DMA, the 100 DMA. Now the 200 DMA will come in focus. It's still a certain distance away. But not too much, 130 points off. And the implied open is anyway suggesting about a 90, 100 point kind of drop. So let's see, the 200 DMA perhaps will come into play again. There's relentless FPI selling. Whoever said that FPIs are going on leave, where are they? They're right here in Mumbai, seems like it. Look at the intense selling, almost 12,000, 13,000 crores so far this week. And yesterday's number was big as well. Net selling of about 4,200 crores yesterday. Domestic institutions have been trying to offset it as usual. Look at the DII buying. I mean, commendable, right? Almost 4,000 crores of DII buying. But clearly, it's not proving to be enough. Because of all of this, where's the Christmas tree? I'm not really feeling it this week. Let's pull up the tally. Nifty is down, and it's all FPI selling, which is why it's large cap selling. So Nifty is down about 3.3%. The Bank Nifty has fallen even more after the RBI policy. I mean, between last week and this week. This week, it's down about almost 3.7%. Relatively speaking, lesser damage on mid caps and small caps. Now to come to the silver lining that Prashant was alluding to. Yes, IT could be in focus because, there is that currency tailwind, though there are hedges in place. I mean, largely speaking, thematically, weaker currencies help exporters. That's one. But more importantly, Accenture's come out with a solid beat. 9% increase in dollar revenue, 90 basis points increase in the margin in the reporting quarter. Not just that, they've hiked their guidance. So what is Accenture saying? That revenue growth is going to be 4 to 7% now versus 3 to 6% earlier. And it's AI powering through all the way. They've added about $1.2 billion in Gen AI orders, taking their total tally to over $4 billion. Looking very, very strong indeed on those Accenture numbers. So watch the IT pack. And there's important news. This is a CNBC-TV18 exclusive. Watch for OMCs and for airline stocks because our colleague Tim C is picking up that finally, something which the industry has been clamoring for years may be at least discussed in the GST Council. What is this? It is the inclusion of ATF, aviation turbine fuel, into the GST framework itself. So it's still at a deliberation stage, but maybe some positive rub-off. But before we get to the stock-specific action, global cues, Nigel, still have plenty to go over.
Well, that's right. The global cues are a little bit murky, and that's a problem. And from an India perspective, we'll be tracking, what the US dollar does, which has moved, to the multi-month highs. In fact, that's at around 108.4, which is, clearly a problem pocket. And that's the highest actually we have seen in the last 2 years or so. That's the problem pocket. And the US dollar yields as well, they continue, US bond yields continue to remain elevated. So both those two, they are not great data points. What happened yesterday? Well, there were some rules that were taking place, given that a lot of people will be going on leave. So there was some lightening of positions that we saw on the futures side. Moving to what do the FIs do? Well, they're not just selling in the cash market, they're adding shorts as well. And sometimes that's a blessing in disguise. So in a single trading session, they added close to around 24,000 contracts, which took their total short positioning to around 67%. And if you pull up a chart, you'll see that they cut some of their shorts, but now they've rebuilt it. And now they've moved up by close to around, in yesterday's trading session, 24,000 contracts. So they have moved to around 1.25 lakh contracts on the short side. The clients, they're doing the exact opposite. So from around 1 lakh contracts, now they're at more than 2 lakh contracts. And overnight, they added 10,000 long contracts is what we saw. The PCR, well, yesterday we were highlighting this fact that it is at the lowest we've seen in multiple months, but that's moved up a little bit. You had call as well as put action yesterday. And yesterday you had the end of the weekly series as well. So there's a new series that's opened up. And the 24,000 call, 24,000 put, both of their premiums in that vicinity of around 200 rupees, which brings us to the levels that we should be tracking. The first support zone is at around 23,800. In all probability, we'll be starting off somewhere around those levels. So that's going to be very, very important. And incidentally, that's where the 200 DMA comes in. So 23,800, that's the important mark on the downside. Resistance comes in at around 24,400, and that incidentally comes where around the 20 DMAs. So we're looking at the DMAs, and we're also looking at the options data, and that's the broad range you're looking at. On the downside, you don't want that level to get taken out. Moving to the Nifty Bank, the 200 DMA is 1,000 points away from current levels. Yesterday, it ended below the 100 DMA as well. So that's a bit of a problem pocket. You don't want it to breach that considerably. Given that the tech space could support, you'll want the Nifty Bank as well to give some kind of support. So we'll have to keep an eye on that. And a few stocks have come out of the F&O ban. So that list comes up for you on the screen. Keep an eye out on all these three names. So we start off in the red. Don't rule out an intraday bounce. But in the near term, this global queue has gone into a bit of a tizzy, which is a problem pocket from an India perspective.
Absolutely. And let's see if we can kind of, see that tinge of green today or not. But let's start with the equity call of the morning. This is a positive one that's actually coming in from Christopher Wood of Jefferies. He says that Fed Chair Jerome Powell in the post-meeting press conference said that the 25 basis points rate cut was a closer call while expressing caution about further cuts. Still, Greenfield's guess for now remains that more Fed rate cuts are coming, if only because of the unacknowledged need to reduce debt servicing costs from a fiscal standpoint. In this respect, it remains to note that the 10-year Treasury bond yield has risen by 87 basis points since the Fed commenced easing in September. This is not what the central bankers would have expected, and it clearly suggests that investors want a term premium for investing in longer-term treasuries.
Okay, well, he goes on to add in that sort of widely read note that some adjustments will be made in the Asia-Pacific ex-Japan relative return portfolio. The weightings in China, Indonesia, and Philippines will be reduced by 0.5 percentage point each, while the weighting in Hong Kong will be reduced by 1 percentage point. In India, he says, the weight will be increased by 1 percentage point, and for Singapore by 1.5 percentage points. We'll put out some specific stocks, etc., in terms of changes in that portfolio in a bit from now. But John Stolzfurt is Managing Director and Chief Investment Strategist at Oppenheimer Asset Management. John, good to have you with us here. Thank you for your time. Are macro markets going to be a little disruptive for emerging market flows? Dollar at where it is, U.S. yields are rising. I think the consensus is still that we'll spend 10-year around 4% in 2025 rather than 5 or above. But what's your sense? Just purely what you're seeing in the U.S. and then indication for EMs.
Well, I would have to say, when we look at the current activity in the market from yesterday to today, of course, it's all about the Federal Reserve and essentially traders pitting themselves against the will of the Federal Reserve. And that's what, whether it was in the bond market or whether it was in the stock market. Essentially, traders are looking for the Fed to make more cuts, while the Federal Reserve looks at the stickiness of inflation that we saw last week in the CPI and in the PPI, and across those gauges of inflation, just some concern there. Now, in the meantime, the Fed has given the market a quarter, 25 basis points cut, but that wasn't enough for the market. What gives us comfort here in the volatility that we've seen over the course of the last 2 days has been that we recall this happened last year. If one remembers, it was late in 2023 when Jerome Powell intimated, coming out of the Fed Funds FOMC meeting, that the Fed would be considering 2024, I believe it was 2 or 3 rate cuts. Immediately, the traders were roiled in their opinion in that they wanted to see the Federal Reserve cut more than just 2 or 3 times. And if you remember, they were disappointed in January. They were disappointed, as I recall, in March, in July, and finally in September is when the Fed began to do their interest rate cuts. But what we do see here that we think is very important to say is we've heard it from you all when you were speaking earlier, the word is resilience, that we're really seeing in areas of revenue growth and profits of corporations in the S&P 500, small business sentiment, the consumers doing what they should be doing. And so for intermediate to long-term investors, this recent volatility is more of an opportunity to catch the babies that get thrown out with the bathwater by the traders who are busy unwinding positions of disappointment in their expectations of what the Fed plans to do this year.
John, hi. Great to have you on the show this Friday. So there's the Fed, and then there is the constant back and forth about this whole shutdown business, right? Is the market taking it seriously at all? I mean, the deadline is, I think, Friday. It's tonight. And then they're not able to agree on a bill, and they've rejected the second bill. But is this serious from a market standpoint? I was reading PIMCO actually has taken note of all of this, and they actually are reducing their long-term, their exposure to long-dated U.S. Treasuries because they're just worried about the deficit. But in the near term, is this a concern?
In the near term, without a doubt, it is some concern. But I would say here in the U.S., the traders and intermediate to long-term investors, their eyes are really on the Federal Reserve and on what resilience the economy is showing. I think it was somewhat expected that the new administration, with President Trump now in his second term, it would be, as usual, he's a very tough negotiator. And within the Republican Party, there's division. And so no doubt, anytime you deal with establishing the budget, you're going to get both sides will be pitted against each other until enough pain is felt politically on the Hill to come to some kind of agreement. But I think this is a little bit early, in our view, we would say, a little bit early for the market to get concerned. We would say if it drags out a long period of time, but short term, a shutdown would not be initially would not be problematic in the sense that it wouldn't cut essential services. But the very fact that they're battling really, I think, is no surprise to most market constituents at this point stateside. For the emerging markets, of course, the effects we're seeing in terms of the Fed's policy, higher interest rates stateside, of course, is problematic. But in terms of where people are buying debt, it really depends. Private investors seem to be very interested in midterm debt as well as short-term debt. It's the institutional investors who will likely consider sticking to the short end of the curve initially here.
All right, John, we got that with regard to the global setup, but let's come back home to India because a lot of our audience will be wondering, what do you do with a market like India? I recall you saying that if the Indian market dips, it's on a good path and it's a good chance to get in. Will you hold on to that view? And among all the global markets, where does India fit in?
We would have to say for many U.S. investors, the biggest problem is the strength of the dollar at this point when it comes to investing wholeheartedly in the emerging markets on a broad basis because of the weakness in the currencies. The problem is when gains are translated, gains are reduced by weak currencies abroad versus the dollar, and losses are accentuated. Income from any dividends paid or interest paid additionally can be reduced by the strength of the dollar. So I'd say in terms of U.S. investors, there's a desire to get increased exposure to India. They've already increased their exposure, I believe, over the course of the last year. We certainly have in our global portfolio that we manage. But at the same time, we've probably got a lot more room to increase exposure to India and other very attractive, similarly attractive emerging markets. But until the dollar begins to weaken, and we're not planning to see that until the dollar weakens, really, the emerging markets remain challenged by the attractiveness of the U.S. dollar at this point in U.S. dollar assets.
John, a great conversation. Thank you very much for joining us, and we'll speak to you in the new year. Appreciate it. Happy holidays. Thank you. Well, we'll just quickly, I just want to put out this tweet, and this is with regards to what is coming up next, which is the risk of this U.S. government shutdown. This is Elon Musk, right? He's not part of the U.S. government, but he's a very important constituent now. And this is what he says in his tweet an hour ago. First of all, I'm not the author of the proposal. Credit to Trump, Vance, and Johnson. Second, this is a much better bill. The bill, he's talking about the bill which was voted down. Much better bill that is closer to being a real continuing resolution, but with support for hurricane victims, farmers, etc. Clean and simple. If Democrats reject this, which they have, and the government shuts down, they deserve to lose big time in the midterms. He's the he's the big one. Who's not in the government, but so much influence. And of course, what he's saying out there is being noted. And Democrats are actually already sort of, in a sarcastic way, calling him President Musk. So interesting times. We'll, of course, take stock of this as we go along and get more views. But we'll take a quick commercial break here as well. We'll come back with our research team in terms of the stocks that we want to focus on. So that's coming up. But let me also quickly tell you the corporate interactions which are lined up on the program. So 8:30, Siddharth Khemka, Motilal Oswal Financial Services joins us. 9 o'clock, we'll have Abhishek Kumar, JM Financial Institutional Securities on Accenture's results and what it means for Indian IT. 9:20, Vineet Sambre will be joining us, Market Master of the Day. 9:30, you'll hear from the management of Poly Medicure. And 9:40 and 9:50, we'll be speaking with two IPOs which are opening today. So it's a primary market which is red hot. Lalit Singhvi of JSW Infra will be our guest at 10:15. And there's an upgrade here, I think, yesterday. So lots to talk about there with JSW Infra as well. Stay tuned.
Time to slip into a snappy break, but on the other side, we'll focus on the top 10 stocks that we're looking at. We're looking at IT services stocks, Bharti Airtel, Exide India, you have Amara, Vari Energies, GE, Vernova, TND, BASF, Chemplast, Sanmar, as well as Cosmo First. All of them will be reacting to positive news flow, and we'll have PNC Infra that will be reacting to negative news flow. Stay tuned, slip into that break, come back, get into further detail on all of these names. Welcome back. You're tuned into Bazaar Morning Call, and as we've been telling you, global markets are a little bit rocky. A lot of stocks we're going to be focusing on, so let's get straight to that. Our research team is standing by with the top stocks for the day. Rima, you go first. Some good news coming in overnight from Accenture, and also we have that index. The IT index has been underperforming. Tell us more.
Yeah, so Accenture's stock price ended up with a gain of 7% after Q1 FY25 earnings beat expectations, and the company went ahead and raised the full-year guidance to 4 to 7% top-line growth versus their earlier guidance of 3 to 6%. The reason for the guidance upgrade was a Q1 beat, which was led by stronger large deals. And there are a lot of the internals which are fairly positive. For instance, BFSI revenues were up 10% year on year. It was a second consecutive quarter for strong headcount addition. The net headcount went up by more than 24,000 in the current quarter. Generative AI bookings are up 20% on a sequential basis, not on a year-on-year basis, on a sequential basis. The Gen AI revenues itself is close to about $500 million. That said, the overall bookings are still a bit subdued, and the management in the conference call indicated that there is still no recovery in client spending, particularly in smaller deals. Clients still prefer the large transformational deals. Europe is a bit more challenging compared to US, and in terms of visibility on budget spends for the next year, they will get clarity only in January and February. But as you said, IT stocks have been a bit subdued. This week itself, the Nifty IT index is down 2.5%. So maybe we'll see a bit of a rebound aided by Accenture, and plus rupee crossing that 85 mark against the dollar also acts as a tailwind.
Okay, so maybe some green on IT names this morning. But Rima, good news for Bharti as well. They've paid off a large chunk of spectrum dues, right?
Indeed, so Bharti Airtel has cleared all the dues for the spectrum that they purchased in 2016. So they've prepaid 3,626 crore rupees. And in total, in this calendar year, 2024, the company has paid about 28,300 crore rupees. The stock has been under pressure, 4.5% lost this week, though this year itself, it's seen a gain of close to about 60-odd%. Back to you.
All right, Rima, thank you very much for that. Well, let's talk about two other names, Exide and Amara Raja. Sudarshan is here to tell us why. So, good morning.
Morning, Prashant. So first one is Exide. Remember in April this year, Exide had signed non-binding agreement with Hyundai and Kia to supply battery cells and battery packs. Now they have signed the term sheet. So basically what does term sheet do? Term sheet formalizes intent to onboard Exide as a supplier of battery cells and packs to both Hyundai and Kia. And this agreement is between Exide's electric mobility arm and Hyundai and Kia. So far, Exide has invested more than rupees 3,100 crore in its electric mobility arm. Next is Amara Raja. So Amara Raja has procurement agreement with Hyundai. Now under that procurement agreement, it will supply absorbent glass matte battery technology to Hyundai. And that technology will be used by Hyundai by Q4 FY25, and it's likely to be used in its Creta EV, which company has a plan to launch by Q4. So that's the reason I'm going with green for both Exide and Amara Raja.
Okay, all right. Thanks a lot for that, Sudarshan. Well, let's go to Vivek. He's tracking a couple of names, Vari as well as PNC Infra. Both of them you're expecting in opposite directions. Tell us more, Vivek.
That's right. Opposite directions is where I expect both of the stocks to react. First up, like you mentioned, let's discuss Vari Energy. Vari Energy, remember, the company has gone ahead and started trial production of a 1.6 gigawatt solar module line. This is in Texas, USA. This is along the lines of what the company has been indicating at the end of Q2 and also at the time of the IPO. Now, remember, at the end of Q2, company's current module capacity stood at 13.3 gigawatts. So again, this particular line goes ahead and augments and adds to the company's existing module capacity. The other stock on the radar is PNC Infra. Some negative news flow over there. Remember, earlier this year, in October 2024, MORTS, which is the Ministry of Road and Transport Highway, had gone ahead and barred the company and its subsidiaries from participating in road tenders for a period of 1 year. The company had gone ahead and challenged this particular decision, but yesterday, the HC went ahead and disposed the plea by the companies and against the Road Ministry order. However, they have asked the Road Ministry order to once again look at the order that they have passed against PNC Infra, and they have asked them to expeditiously take a decision, hopefully within 4 weeks is the kind of timeline that they have provided.
Okay, so basically the court's asking the ministry to do a review and reconsider perhaps its decision. Got it, Vivek, so we'll watch out for PNC Infratech as well. Moving on to Vamakshi. She is watching out for a bunch of stocks this morning. Good morning, Vamakshi.
Good morning, Surbhi. Let me first start off with GE Vernova TND. The stock is in focus on the back of an order win. They won an order worth over 400 crores from Sterlite Grid. This is for supply of high voltage equipment. And analysts estimate that with this order now coming in, the company is now sitting on a backlog of somewhere around 10,000 crores. And this is despite not having won any HVDC contract in India yet. So that bodes well for this company, and therefore I'm going with the green for this counter. But apart from that, keep an eye out on BASF as well, and that is because the board has given an in-principle nod for demerger of the company's Agri Solutions business into a separate listed legal entity. This will enable operational flexibility, leverage differentiated steering, and create value for the shareholders. Now, keep in mind that the contribution from this business was somewhere around 14.5% in FY24, with the revenue standing at 2,006 crores. Keep in mind that the company in September had also indicated that globally BASF SE will complete legal and ERP separation of Agri Solutions business by 2027. So this announcement is a step in that direction, and therefore going with the green for this counter as well. Chemplast Sanmar commenced commercial production from the second phase of multi-purpose production block at their custom manufacturing chemicals division in Berigai, and therefore going with the green for this counter. And lastly, let's focus on Cosmo first. They've launched an innovative paint protection film. This has been designed to preserve and enhance automotive exteriors, and the company is expected to begin market trials for this product. So given that announcement, going with the green for Cosmo first as well.
All right. Well, thanks very much, Vamakshi, for that. Well, here's a quick recap of the stocks that we've put out. So on the positive side, you've got names in the IT services space: Bharti, Excite, Amar Raja, Vari Energies, GE Vernova, BASF India, Chemplast Sanmar, and Cosmo First. And the only one on the negative side is PNC Infrastructure. Well, we'll go across to Manisha now from stocks to commodities. What's top of mind? Manisha, good morning.
Morning, and thank you for that, Prashant. Well, we are headed for a weak week when it comes to various of these commodities, especially with the dollar index still holding above 108. We've seen the crude oil prices continue to decline. Adding to woes is Sinopec's China statement. Sinopec, by the way, is the largest Chinese refinery. It says that the gasoline demand in China has already peaked in 2023, and that weighed onto the markets. In any case, the street is anticipating that 2025 will see excess oil availability in the world, and that will keep the prices under pressure. But it's not just energy, because when you look at metals, we've seen serious declines continuing into this week. Overnight, copper prices fell by 2%, silver was down 1%. With the declines now, nickel is trading at a 4-year lows, and 1 month lows continue in case of metals like zinc and aluminum as well. The only thing that I see on my charts trading in the positive is the natural gas, and that is trading on a firmer note because this is cyclical, this is winter demand. The natural gas prices have gained up by nearly 12% in last 1 month, trading at a 13-month highs. Barring natural gas, everything else is trading in the weakness.
Okay, all right, Manisha, got that. Thanks very much. So we'll watch out for how some of these commodities fare during the course of the day. Quick break at this moment. On the other side, we'll have Siddharth Khemka of Motilal Oswal Financial Services joining in. We'll discuss some of the top stocks to watch today and a few more fundamental ideas.
Welcome back. Well, as promised, we told you all about the top 10 stocks that we are tracking. Now let's get into some more fundamental analysis. To help us out, we have Sid Khemka, who joins us. Hi, Sid. Good morning. Well, tech stocks, they should do well to start off trade with. But I'll tell you what, yesterday, if you looked at the index, a couple of stocks were already seeing a good amount of long build-up and some delivery-based buying as well. But what's your view on the stocks? Because you have the index that's underperformed in the last few days. You have the rupee that's weakened, which is the tailwind. And Accenture's numbers should be good times as well. What do you like from the tech space?
Yeah, good morning, Michael. Glad to be on the show. So I think, yes, there were some concerns, especially after the Fed commentary, that the interest rate cut may not be at that pace. And hence, there were some concerns with regard to the spending going forward for IT. But I think overall, we are constructive on the technology space. We believe recovery will happen at a much faster pace. And I think results only want to show that the recovery is picking up pace. The overall performance has been good in terms of revenue growth. It has been at the higher end of the guidance. And the good part is that there is an improving demand environment with clients remaining committed to large-scale transfer.
Yeah, Siddharth, we'll come back to you in just a bit. For the time being, we'll just get the bit of that audio glitch sorted.
Absolutely. Let's use that opportunity actually while we fix Siddharth's audio to play out some of our sound bites from the market town hall that we had a day before yesterday. And, we had Niket Shah of Motilal Mutual Fund, Rohit Shimpi of SBI Mutual Fund, Tahir Badshaw of Invesco. We played out some sound bites yesterday with regards to overall market views. This is the bets they're they want to make in 2025 and beyond. The themes that they'd like to put money behind. So listen in to some of these sort of specific ideas where, buckets of ideas where you'll find stocks. Listen in.
We do believe manufacturing will really play an important role as we get into 2025. So if you just look at the broader numbers, US has about 5.5% of the world's population, contributes to 25% of world GDP. Europe has about 4.5% of world population, contributes to 18% of world GDP. China has 17% of world population, contributes to 17% of GDP. India has 17.5% of world population, contributes only 3% of world GDP.
So that's what the opportunity.
So there has to be a significant movement, from mean reversion, right? And how do you do that? The only way you do that is manufacturing, and within manufacturing, you have to do more exports, right? That's how you get incremental GDP from 3% to 5 or 7% over a period of time. GLP-1 obviously is probably the largest in mankind. We're now touching broadly about $50 billion worth of sale. There are still countries like Europe, India, some part of China, which still doesn't have a GLP being launched at scale. So a lot of states within Europe and China don't have GLP-1s. And I think that clearly means that this particular molecule will continue to grow at very rapid pace, at least for the next 3 to 4 years. Now, there are multiple ways to play. One is obviously you play the API player. If there's an API player who will supply the API to the generic guys, that's still a very significant size of opportunity. The second is the generic guy itself, who decides to launch a generic version for Lira or Sema as and when, because the Sema gets into off-patent in 2032 in US, but other markets are still quite large, which incrementally means that there is a generic opportunity for the generic pharmaceutical players. Third is device manufacturers.
The power utilities in the power segment, but more particularly within the power value chain, the transmission portion of the power economy. And that's because we, as we all know, are in the midst of this massive change where you look at installed capacity being in renewables. Transformers, all kinds of equipment which are related to actually upgrading the whole transmission system.
The grid, basically.
The grid, because you are going instabilities induced because of this intervention of different kinds of power sources. So, and we've not done anything to the power transmission system in a very long period of time.
What kind of names? I mean, just to kind of
talking about companies like Hitachi, GE Vernova, these are kind of guys who are going to, maybe even to some extent, even the likes of Siemens and ABB.
For lower end consumption, and I think we've seen this, happen in a big way post-COVID, that the recovery has been extremely K-shaped. If you'll go back, even something like two-wheelers, been doing badly from 2019 onwards, right? So it's even before COVID that space was probably struggling.
Yeah.
Now that it's been a while, there's been some change at the margin in terms of government policy, at least from the states coming out with some income transfers, etc. I think that is something which probably is driving a bit of growth out there, and just the fact that it's been poor for so many years, right? So just that, catch up, the sticker shock in terms of two-wheelers kind of, finally consumers are getting used to that.
All right, those are some of the highlights from our markets town hall that happened earlier in the week. Let's go back to Siddharth Khemka now, get in some fundamental cues and ideas. Siddharth, I hope we can now, hear you better. So let's go back and, complete that point that you were making on IT. Accenture's numbers are good, but the question is, can we extrapolate that, and should we assume that at least there'll be a bit of an uptrade on some of the IT names?
Yeah, good morning. Sorry for that. audio issue. I think if you look at the overall Accenture numbers, I think that's a positive read-through for Indian companies, especially if you look at the guidance upgrade. That definitely underscores the improving backdrop for Indian IT players. The quarterly numbers have been pretty good in terms of the revenue performance has been at the upper end of the guidance. What we are also seeing is that the clients remain committed to large-scale transformation initiatives, which is where we believe that Indian companies, especially the larger tier 1 players, are well positioned to capitalize on the recovery in the overall growth. Also the fact that Gen AI continues to gain traction and some of the data infrastructure building up that players like HCL Tech are geared to benefit. So I think overall the environment looks conducive, especially for the tier 1 players where we are more constructive, while the tier 2 players have reported strong growth and continue to do well. I think from here on, the major read-through from Accenture would be that we should also a constructive view can be created for the large cap IT names. For example, what we like, HCL Tech is our preferred pick within the overall space, followed by a TCS and an Infosys.
Okay. All right. Siddharth, stay on. We'll come back with more questions, but we do have to slip into a very quick break. Back on the other side, more fundamental stock ideas, and also we'll have all our technical experts join in. So we'll give you some trading cues as well with Mitesh Thakkar and Shrikant Chauhan.
Welcome back. Well, as promised, let's get straight to our technical experts. We have Mitesh as well as Shrikant who join in on this Friday morning. Good morning, gentlemen. The party is later this evening, but first, you've got a few hours of trading. Mitesh, tell us, what would you do? The last few days have been a little bit rocky. Global cues ain't positive, and you have been sounding a little downbeat as well. What would you do given that the Nifty is going to be down 100 points to kickstart trade?
Yeah. Good morning, Nigel. So I think, the first thing which should a trader make a note of is the fact that with this 100-point gap down, we'll open right around the 200-day average, which yesterday was about 23,825, 826, and it's gaining about 10 points every day, so roughly around 23,850, 840 zone. So again, yesterday in some bounce back, we had got into some put spreads. I think we'll again try to book those short positions and see if the 200 average is holding and giving you a bounce back. But the structure is weak. So on a bounce back sell, or if we see a 30-point break below 200 average, I think reinitiate put spread with new strikes. So I think the bearish outlook on the index continues, and would believe that if the 200-day average gets taken out right now, then I think we will test 23,500, 450 zones, or in case you get a bounce back, then a chance to sell closer to about 24,000, 24,050 odd zones.
Okay, all right, got that. Let's go to Shrikant as well. Shrikant, morning to you too. What about the index calls? It's been a tough week for the bulls.
Good morning, Sylvie. Good morning, Nigel. Yeah, I think it was not at all expected that the market can fall like this after the last Friday's recovery. But the market has broken all its important level, and now the markets are very close to its important support levels like 23,700 or 800. Where the market is having support of 200-day simple moving average. At the same time, if we consider the put-call ratio of the month, then it is also to the extreme oversold level. So I am of the view that yes, we may see some more weakness in the first half, but in the second half, I think there should be some recovery because the overall oversold activity is out of formation. Also, the Bank Nifty has also fallen to its important support levels, and now the next level to watch out for would be 51,600, 650, where the Bank Nifty has left a bearish gap in the month of November. Bullish gap, in the month of November. So broadly, I am of the view that today, in the second half, the market should recover from the lower levels. But at the same time, we need to wait and we need to see that whether the market is forming any reversal formation or not. Based on that, we can take a call. 24,000 is definitely going to act as important resistance for the market. And on the downside, 23,700 should be the next level to watch out for.
Okay, all right. Let's get to picks. Mitesh, what's the top pick you have for us today?
Nigel, I have a mix of buy and sell. I think, IT and pharma is a space which is looking good to me, and that could be a good counter hedge against the short in the stock portfolio or the put spreads on the index. So I have a buy on Ipca Labs if it starts getting past yesterday's high, about 1603, buy with a stop at 1580. Look for targets of 1665. And the other one is also a buy call from the IT pack, which is OFSS, which I would want to buy on a decline. So in case we get a gap down, in case we get the stock at lower levels around 12,700, 720 zones, buy the stop at 12,450, 440, and look for a target of 13,500. On the selling side are two automobile stocks. Ashok Leyland is a sell with a stop at 222, targets of 212, and Escorts is a sell with a stop at 3315 for targets of 3220.
Okay. All right, Shrikant, what about you?
Yeah, I think IT stocks are, yesterday we saw some sell-off, but Infosys was very close to its important support levels and it closed little higher from its opening level. While looking at the entire setup of the stock, I am of the view that again it is going to rebound and we are expecting stock to remain in a range of 1900 or maybe 2100 for the next few days or few weeks. So at this level, the risk reward ratio is quite favorable. At this level, it's a buy with a stop loss close to 1900 levels. And again, we can see the levels of maybe 2000, 2015 next 1 or 2 days of time. So it's a buy at current levels and more on dips. The other stock on which I'm bearish is AU Bank. It is consistently falling from the highs, and on Thursday, it has broken its important support line at 560. So from here, the stock can fall to the next levels of 500 or maybe 490. At this level, AU Bank is a short with a stop loss close to 570 for the target of 500.
Okay. All right, Shrikant and Mitesh, thanks very much for the picks. We'll come back to you a little closer to market opening. Take a break right now. We'll be back. We'll have some sense of how the pre-opening rates are looking. And we'll also be in conversation with Abhishek Kumar of JM Financial Institutional Securities. Talk about what this big positive Accenture reporting and their higher guidance, what does it actually mean for Indian IT services?
All right, well, the pre-open session is going to come up on your screens. There's about, 14 to go for the market open itself. We're down 50 points. We are up 50 points, 24,005. And the sensex is up about, okay, this is a little all over the place. There you go, it almost immediately ticking down. And things will settle down in a bit from now. IT maybe, again, is very early. But will we see a bit of a lift in IT stocks on the back of Accenture results? If we can have the Infi, the TCSs of the world, maybe the Wipro, Tech Mahindra, and see if it's showing up here. Accenture, of course, has beaten expectations and has raised its revenue guidance. So the IT services stocks in a bit from now. And of course, we've got a discussion lined up with our with the analyst on the other side as well. I think Siddharth Khemka is with us. Siddharth, thanks for waiting, first of all. I believe we fixed that issue, that audio issue. Lots of movers, Siddharth. And so just a few names. I don't know if you'll have coverage, but and these are all maybe at the margin, turn stocks, right? So Chennai Petro made a move yesterday. We were discussing this technically yesterday with a guest. IOL Pharma was started to turn a little bit at the margin. These smaller EMS companies, Avalon, Centum. Centum, of course, has done very well lately. Any thoughts if you own any of them or have tracked it?
Yeah, sure. Thanks, Prashant. So basically, if you look at some of these names, you have to see the space and sector where they are. And for example, Chennai Petro, we are seeing that the GRMs have improved sequentially on a Q-on-Q basis. Plus, we are seeing that the EBITDA margins for some of these oil refining companies could see a significant jump, almost 60% EBITDA jump on a sequential basis, mainly on the back of the improvement in both GRMs as well as the marketing margins. And that is leading to the interest in this space. So while we have coverage on the larger ones, we like HPCL, which is a preferred pick within the
the entire OMCs. Chini Petro being the small size, we are seeing consistently last 15-20 days in this market environment where while Nifty has moved up and then last 2 days we saw the struggle, mid cap and small caps has consistently seen a good uptick and a lot of interest despite the FI's sellout. I think mid and small cap space is consistently doing well. So the other space you talked about, Avalon, we do have coverage and we like the stock. EMS as a space is doing well consistently. So if you look also at some of the larger ones like the likes of Keynes, Sirma, I think they have also delivered returns in the last few days on back of investor interest. But the overall space, the electronics manufacturing, I think that is witnessing significant uptick in terms of growth, and the earnings delivery is something that is driving demand for stocks in this space.
Okay. All right, Siddharth, thanks for being with us today. You have a good Friday, and I look forward to connecting again. In case we don't speak till the end of the year, then happy holidays, but we'll probably talk again before the year goes out. Going back to that top story on Accenture, now we all know about this big beat, 9% quarterly revenue growth coming in, which was higher than estimates. There was margin expansion as well. Not just that, the company went ahead and raised its full year guidance for FY25 from 3 to 6%. Now that guidance band is 4 to 7%. So what's the read-through for Indian IT? Abhishek Kumar, who tracks the space at JM Financial Institutional Securities, is with us. Abhishek, thanks for joining in. You know, your note was very interesting because if I'm getting it right, what you're saying is that this could actually not necessarily be positive for Indian IT because some of this strong growth could be coming at the expense of the larger Indian IT service providers, maybe some market share gains in favor of Accenture. So just expand on that point and tell us why you're not really, jumping from the rooftops with this strong Accenture beat.
Yeah, hi. First of all, good morning and thanks for having me here. So you're right. What I feel is that, the large deal market has been very competitive, and Accenture did flag that off, that they're seeing lower pricing through the quarter. And if we just do the analysis of market share of TCV, Accenture's market share has increased by almost 8 percentage point, year over year in the first half of this year. And we are talking about last 12-month deal, not just 1 quarter deal. So it seems that, and at the same time, we have seen the likes of Infosys and TCS reporting slightly weaker deal wins. So it seems that Accenture is winning more at this point. They have been very vocal in saying that they have pivoted towards larger transformation deals. So given that the client budgets are still constrained, there are no signs of discretionary pickup as yet, and a limited pool of deals in the market. A larger player winning and beating revenues on the back of those deals ramping up is not necessarily a positive read-through for the peers. So yeah, that's my take on Accenture.
Okay, all right. You're pouring some cold water this morning, Abhishek, on the enthusiasm that we had, but making very, very valid points. A couple of positives, though, is like the BFSI segment that they reported. There was a good sequential growth out there. Shouldn't that be a positive read-through for those companies that have a higher exposure out there? How do you see that panning out? And also tell us, what is your top pick from the tech space?
Yeah, so first on BFSI, yes. So see, I think, there are positives clearly out of the result. I'm just not as enthused as what the stock reaction reflected. As you said, financial services, clearly a positive. The growth was broad-based, and also the fact that there were no negative surprises, right? We are coming out of a period where constantly there were client-specific ramp downs or some other negatives, which were kind of, clouding the overall growth. But no negative surprises is a positive thing. But it's not just all hunky-dory already. So that's on Accenture. In terms of picks, I think I would still stick with players where there is earnings resilience or valuation comfort. So among large cap, Infosys, Wipro, Tech Mahindra, we like. Mid cap, we like persistent and emphasis.
All right, no, absolutely. Abhishek, so for those sort of watching day-on-day kind of reactions, I think what takeaway is maybe if you get a bit of a pop, by the end of the day, things fade out, right? On the back of this, just this Accenture pop. And you put out those sort of picks, etc. As well. So the big story from a US perspective, of course, is going to be Trump and what he does, etc. Anything from that policy perspective which will matter? Or you think it's just the underlying sort of fundamentals and demand environment, etc., which will be important. By the way, I was reading, there was this AWS conference, and I was reading notes of it, and there was general this view expressed that US government software spending is like something that both Musk and Mr. Ramaswamy want to cut, and they hate it. I am not sure how exposed Indian IT services companies are to that segment per se, maybe at a first level or a second order impact. Any thoughts at all, Abhishek?
Yeah, you're right. I think Trump administration is looking at making their tech spend a lot more efficient. And Indian IT services players do not explicitly disclose their exposure to US federal government. Accenture obviously has a higher exposure to federal government in US. But my sense is, whenever there is a need for efficiency in a tech landscape, IT services players generally, benefit from that. I don't know what is the current status of their tech spend, how much of it goes into software licenses and how much of it goes into services. So we need to be, it needs to be a more nuanced analysis before we can figure out if services players will necessarily benefit or, will lose out. But I think, any thought process towards making things efficient generally we have seen is positive for the services players.
Abhishek, one final point. Again, now the currency, sentimentally, we all know directionally it's a good thing if the rupee depreciates for any exporter, including IT service exporters. But have you had a look at the recent positions in terms of the hedges and what kind of cross-currency impact we should be prepared for with the rupee now faltering to 85?
Yeah, so I have not looked at hedges, but just in terms of cross-currency, there will be a negative impact this quarter because, dollar has strengthened against all currencies, right? Not just rupee, against euro, GBP, and those would result in, maybe 1 percentage point impact in terms of cross-currency headwind for the quarter, for the sector in this quarter.
All right, Abhishek, we'll leave it there. Thank you very much for joining us. So that is the view coming in from JM Financials, Abhishek, on IT services. We'll go across to Mitesh now and Sudarshan to get their 9-10 picks. Mitesh, what do you have?
I think I'll go with a sell call on escorts for targets of 30 to 20.
Okay, all right. So that's what's coming through in terms of trades. These IT names, anything catch your eye, Mitesh, technically?
I had a buy on OFSs, but I think I like the entire pack, and the strongest in the short term would be OFSs. To a certain extent, Infosys, because Infosys, yesterday had a pullback, and if it can capture yesterday's high or day before yesterday's low around 1985, then I think I would look at 20, 40, 50 as the near-term target.
Okay, all right. That's Infi there, 1.5% higher. Thanks very much, Mitesh. We'll talk soon again. Well, let's go across to Sud now with the spotlight on Exide. Sud, morning.
Morning, Prashant. So remember, on 8th of April this year, Exide had signed non-binding agreement with Hyundai and Kia to supply battery cells and packs. And on that day, stock price was rupees 321. And from that level, stock had almost doubled to hit the high of 630. And from 630, now it's down almost 30%, trading around 435 odd. So now the update on the news is that now Exide has signed term sheet with Hyundai and Kia to supply battery cells and packs. So what does this term sheet do? Basically, it allows Hyundai and Kia to onboard Exide as the supplier, and this agreement is between Exide's electric mobility arm with Hyundai and Kia. And so far, Exide has invested almost 3,100 crore in its electric mobility arm. So overall, it's positive for Exide.
Okay, all right, got that. We've got, thanks Sod for that. We've got Hormaz joining in. He's looking at a couple of brokerage notes, fresh calls, initiations coming in. Which ones are these, Hormaz?
More initiations coming in. First one is on Sagility. It's a recently listed company. Jefferies has initiated with buy recommendation of 52 rupee price target, around about an 18% upside from where it closed yesterday. It said that it is well positioned to gain market share in the segments that it operates in. Over FY25 to 27, it expects a 12% profit CAGR and a 40% profit CAGR, and that will happen once the depreciation and amortization costs normalize and a deleveraging of its balance sheet happens, and that the EBIT margins will also are expected to double to nearly 16.5% over the same period, and it is because of the superior earnings growth where Jefferies expects these valuations to sustain. Now Anant Raj has also seen an initiation from Motilal Oswal, a buy recommendation, 1100 rupee price target and almost 30% upside as well. Now it's saying that it is riding the India's data center localization wave, and it says that there are multiple growth levers at play for the company. Now although execution risks remain for the company, Motilal Oswal is expecting long-term value creation to take place in Anant Raj because of the revenue and margin expansion, and it is expecting a revenue growth of around 26.5% this year and margins to improve to 50% by FY26 compared to around 22% in FY24. So positive commentary coming in there for Anant Raj as well.
All right, Hormuz, thank you very much for that. This absolutely a red-hot market in terms of everything. Capital market activity is really up there. Primary market activity, new initiations on already sort of older existing stocks and whatnot. So really exciting times. We've got a 100-point gain on the sensex and about a 9-point gain on the nifty. That is at least what the pre-open is showing us. And in a few seconds, we'll have the first rates which will start to appear. We'll, of course, look at the indices, and then we'll get down to individual stocks and what's really happening. Same time yesterday, we were staring at a bit of a cut. But we, of course, by 3:30 had seen a fair bit of recovery and repair, especially in the broader market, and it was not so bad. So what do we have this morning? The first rates, and of course, I mean, in terms of stocks, etc., there is the entire IT services space. There are all these initiations which Hormuz spoke about, and of course, names like Exide as well. So there you go. We get going. 18 points, 8 points, 10 points, 23,950 basically on the Nifty is what you have. The Nifty Bank is starting slightly lower, 51,500. The Sensex is kind of 0.1% lower. Mid-cap index starts about 0.25% higher. So it's mixed. It's all largely in the red. IT is up about 1% or so. The heat map, again, kind of mixed. More down than up, though, at least to begin the day with. Surabhi.
It's all IT on the upside, really. Those are the only names fighting for the bulls right now. TCS, Wipro, Infosys. TCS is doing very, very well. 2.5% up, perhaps expecting this exuberance in terms of large deals to rub off on the Indian space as well. Tech Mahindra is also up about 0.5%. Bharti Airtel, which has prepaid a large chunk of its spectrum dues over, I think, 3,000 crores. That stock's reacting well as well for the time being. But then the list completely fizzles out. Don't have too many other gainers to speak of. Banks are flat. ICICI Bank, SBI, IndusInd, they're all at the flat line, unable to make up their minds. If you look at the downside of the screen, there's some profit taking coming in on some of the auto names like Eicher, Tata Motors on the lower side, Maruti slightly lower as well. And Reliance is down about 0.5%, which actually brings me to the downside of the screen. L&T, ITC exerting lots of downside weight over here. No excitement in the metal names, global facing names like Tata Steel. Hindalco also I saw starting off negative. And then nothing's really adding up. Consumers down about, a couple of percentage points. HUL, for instance, lower. Tata Consumer on the lower side. So very quiet on the Nifty. Now it's a 50-point dip, by the way. So 23,900 is in question. Remember, the 200-day moving average comes in around 23,815, 816 thereabouts. So looks like the bulls want to test that. 50 points lower now.
Well, that's right. Let's run you through a few stocks that are doing well. IKS, the stock is up close to around 5%. So had a good listing. It's building on to those gains. You have BGR Energy. That stock as well is up, moving from circuit to circuit. So that's higher. Sagility, we had that initiating coverage report. So that stock, in fact, is buzzing in today's trading session. It's building onto those gains, up close to around 5% as we speak. MobiKwik, yesterday it corrected close to around 7% from the high point of the day. Today it's got back to its winning ways. Exide, on that news that Sudarshan told us earlier today, which is a positive read-through, That stock as well is moving us. AGS Transact, one of those underperformers, that's bouncing back in trade today on very high volumes. And Greaves Cotton's the other one that's holding mildly in the green. What's not doing too well? PC Jewelers coming for profit taking, down 5%. RBL Bank coming out of the F&O ban. Well, that one in fact is down close to around 2%. Just one word, keep an eye out on Zomato today because the Sensex and the FTSE rejig is scheduled for today. So towards the end of the trading session, I think that's another stock that you should be keeping on your radar for the day because of that rejig. You have a note coming in from Nuvama that says that's a stock to track for today's trade. Otherwise, more or less, flattish to a mildly negative start. And just one more stock, Granules India. I recall on the day you had that negative news flow, the stock had corrected from around 620 to 520. After that, it went into the F&O ban. And we were saying that it's a high probability that the shorts could get stuck into the system. Take a look at what's happened. From 520, 530, the stock has bounced back and made up all of those losses. That's the power sometimes of short covering, of the shorts getting squeezed out on the wrong side. So after that sharp decline, it's recovered almost all of those losses. So keep an eye out on that one. Prashant.
Absolutely. And, lots of names moving around. By the way, in the index, we got about a 40-odd point cut. Just a few more stocks here. IKS, the listing is from yesterday, listed with a 40% gain, is the top volume-led gainer by far. It's up another 5%. There's MobiKwik. MobiKwik was day before yesterday's listing. Saw some, I think, it came off the highs yesterday, started higher, but 3% higher, big volumes. Sagility is at number 3, volume-led gains, 4% again. So 45, there's that Jeffries note, but stocks basically doubled from when it hit the market. And now, of course, there's this initiation coming. So be mindful of that. Exide, of course, Sud's been talking about. Amar Raja, I think we've highlighted. I highlighted Avalon in the morning with Mitesh, Avalon and Centum with, I think, Siddharth. Avalon is up 7%. Was a big mover yesterday, and there's momentum here, 1,062, and it's got volumes to boot. Look at 63 Moons. 63 Moons, it's not on another circuit, let me put it that way. It's moved up from $450 2 months back to 1,000 plus, and it's up 3%. Look, about 100,000 shares in terms of volumes as well. Samman Capital, the erstwhile Indiabulls Housing Finance, is up 2.5%. And I can go down the list, but that's it. I mean, in terms of if you wanted to do a volume cutoff on these gainers, that's it. Sai Life is down 1%. I just want to take a quick look at Vishal Megamart as well, which is a listing from day before yesterday. Vishal, of course, hit a 50,000 crore market cap, came to the market at 35,000 crore market cap. 50,000 yesterday ended lower, and it's about 106 odd rupees, 107 odd rupees. It's up about 7 million shares right now. So
just adding one or two more consumer names that are making a move. Swiggy is on the move now, 3% up. Volumes are also picking up on this counter. There's Pratap Snacks, which is interesting this morning, 13% up on Pratap Snacks. And I saw, Liberty Shoes cross. By Liberty is interesting. One or two sessions, it's just from nowhere. It started to move higher, and this morning as well, there's some green on Liberty Shoes, 6% up.
So on Pratap Snacks, Stallion Asset, yesterday they bought close to 3.7 lakh shares in the company. I think that's something that's excited the street, and that's why that stock is up. Volumes as well, rather high. I think 2.5 lakh shares, we'll never see that. In an entire day, I think it does close to around 5 lakh shares or thereabouts. So very high volumes. That could be one of the triggers why it's moved up.
Absolutely, and we'll have more on this a little later on the program. Our market master of the day is Vineet Sambre, Head of Equities, DSP Mutual Fund. He's joining us now. Vineet, good to have you with us here. Good morning. Thank you very much. Is the primary market activity keeping you busy, Vineet?
Not really.
Or the secondary market? No? You're not on the anchor prowl?
No. So actually, if you just look at the participation, we have been very selective as compared to the street, and it is to do really with the kind of market levels, valuations. So I think it's better to be on safe side than look at all of them.
No, absolutely, but it's crazy, right? I mean, the rush to get anchor allotment. I mean, the rule this week has been 40% listing gains. I mean, almost like a done thing.
No, but see, I think while it is all going good, but still, I mean, there is a lot of euphoria. I mean, people are there's a mad rush. So I would say it is also linked a lot to, how people are actually looking at, like you mentioned, anchor demand. So I think that is leading to a lot of this exuberance. But I think, at some point, a lot of the money will also move out from the secondary market to primary market, and then it will have its own bearing on the overall market. Then I think one has to be more, as I said, more rational and picky about where you are investing.
I mean, the primary market has been hot. And by the way, I want to say, and we'll put the story out later. We broke the story late evening yesterday that Flipkart, the big e-commerce player, is now also looking at an IPO. I mean, it's on the road to IPO. So if you thought 2024 was busy, I think 2025 is going to be equally, if not more busy. It's a lot of stuff lined up, which will hit the primary market going forward as well. Vineet, I must say, though, a lot of interesting business models, right? I mean, expensive, not, etc. is different. But look at Sagility, IKS. We don't have those kind of listed peers in that sense, right? Which are making it to the market. Today, we are speaking with a hotel company, but that's, of course, lots of listed players now. Somebody in the auto transmission space, again. But a lot of newer business models also over the last 1 or 2 months, which have made it to the market.
No, I think this is a very valid point, Prashant, and this is what we also are very excited generally about, because India's growth is really looking very broad-based, and like you mentioned, new models have come. Few years back, we had the largest EMS company, or the outsourced manufacturing company, coming up with the IPO. We had also participated, and today it is a large cap company. It has crossed 1 lakh crore in terms of market capitalization. So I think there are very valuable pieces of business which are actually coming up in terms of new issuances. There are new areas to look at, and I think from that perspective, India as a country, it is also leading to a lot of de-risking, and also making the mid and small cap, let's say, more relevant from a participation perspective as compared to large cap. Because in general, I think people have been worried about the mid and small caps as well because of valuation, which is right. But in a way, there are so many segments where otherwise you can't participate via large cap. So I think you're right. These are interesting times. Over a course of a full cycle, maybe some of this business will truly create great value. Some may fizzle out, but which is where I think we need to sort of differentiate between the men and the boys, actually.
Glad you brought up that point, Vineet. Hi, good morning, Surabhi here. Great to have you on the show. Because I was looking just at that data in terms of performance. I mean, the stark outperformance of the mid-cap space, right? 33% in this year versus 10% on the Nifty. Even in December, the Nifty is down 1%. The mid-cap index is up 5%. And individual mid-caps have done much, much better. So now, to separate the men from the boys, so let's talk about some of the themes where you still see reasonable valuation comfort, reasonable growth comfort. Find those pockets for us. At least sort of name them out. EMS, consumer technology, names like Swiggy, etc. Just name some areas where you still have comfort of taking a fresh investment call.
So before I talk about the sectors, let me say that at a very high level, the way we are thinking today is in terms of the absolute valuations. I don't see great margin of safety across all the sectors broadly. But where we are trying to seek margin of safety maybe is in the business cycles, or like you mentioned, visibility of growth. So I would say that one big theme which we believe should sort of come back would be the rural theme. Because after a long period of 1-2 years of underperformance, we are seeing that because of the welfare spends which are happening, or the rural income generally has been okay. I think that's one theme which one should sort of think about. Now there are various pockets within the rural and the semi-urban. Maybe one can look at largely. So that is one area we are looking at. So within that, maybe consumer, both discretionary, non-discretionary, is the way to play. There has been a lot of building material, the real estate which has got sold, and building material sector has still not shown the kind of upsides or the growth momentum, which we believe should happen at some point in time. And that is an area where I think we will see better visibility of growth, and which is where we are sort of looking at. The other segments are the ones which we have been anyways positive over long period of time. Healthcare, because that is a category which sustainably keeps growing as far as the domestic market is concerned at 11 to 12% and doesn't shock you a lot. And depending upon how their international businesses pan out, should do well. IT sector, I feel quite positive on the IT sector. There are a lot of headwinds which are coming up in terms of the AI shift and all of that. But I still believe that the sector has a potential to deliver good returns over a period of time. So I think these are maybe few segments which I can recall are sort of at least showing better visibility of growth, and it's okay to be part of that.
IT select IT stocks will do well as well. Hi Vineet, good morning and good to see you. Vineet, since we're almost at the end of 2024, which has been a decent year, even with the recent dizziness that we're seeing in the markets, the first 10 months were rather good. 2025, what is your expectations on the headline index? It's expected to be a difficult year, so that's why I ask you that. Should we be satisfied with some kind of a consolidation? Do you think that we could have a big down year? And also, this year was a year of mid and small caps. Next year, do you think it's going to be a year for large caps?
So I think, Nigel, very important question. And the way to think about the market is that it follows the earnings growth. And last 2-3 years has been very high in terms of the earnings growth. We have CAGR at over 20% plus. And now suddenly we are staring at, low single digit kind of earnings. Maybe September quarter was the first quarter of a very low earnings. And I think this low earnings momentum looks like sustaining for a quarter or two, because even the confidence is not yet back when we are talking to companies for the December quarter. So I would imagine that we are starting on a very cautious note, and maybe the market there's a room for consolidation, some correction over the course of the next, at least first half. And post that, maybe depending upon how the growth metrics pick up, like I said, I'm positive on the rural side of the consumption. That should add, maybe government spends also start picking up. And a low base formation towards the March quarter should mean that starting, the second half of calendar year 25, we should start seeing some direction which the market would pick up in terms of growth. So to me, I think growth remains the most important aspect, fundamental aspect. It can take care of many problems as such, and till the time that returns, I won't see market scaling new highs is my assessment.
Vineet, this maybe is the last interaction for 24 and we look ahead into 25 and beyond. Any one kind of micro theme where fast growing area where one can still find something reasonable out there? Of course, we can't talk stocks, but I'd love to. But what would that be? One space.
Sure. So Prashant, within the lending space, we are going through a bit of a stressful time. And in general, I think NBFCs have played a very good role as far as growth is concerned and good quality of assets is concerned. I'm assuming that the stress currently which we are seeing should spread and maybe over the course of next 1 or 2 quarters before we start seeing base formation there. I would be really interested to look at some of the excellent NBFCs within different pockets, maybe CVs or other personal finance and all of those, where I believe that if the stress leads to correction in that space, that's one space which can provide good returns over cycle. So I think we'll have to live through this difficult period for 1 or 2 quarters where you will get good opportunities. Is my assessment.
Got it. All right, Vineet, thanks a lot for your words of advice with regard to the outlook as well as on current positioning of the markets. Wishing you all the best for the remainder of this year, Vineet, and looking forward to chat up with you in 2025.
Surely, Happy New Year, all of you. Thanks. Bye.
Happy New Year, Vineet. Well, time to move on then. Poly Medicare, that's a stock in focus. I'll tell you what, in this year, we talk about being a good year. The stock has given you returns of more than 75% in 2024 so far. IIFL Securities, they in their recent report suggest that the Indian medical devices industry is expected to clock 11 to 12% CAGR over the next few years. Discuss the opportunity, what it means for the company. We're joined by Mr. Himanshu Baid, the Managing Director at Poly Medicare. Hi, Mr. Baid, good morning and thanks a lot for joining. And I recall a couple of Christmases ago where I called you up and I said, I want to understand the opportunity. And you said, Nigel, the opportunity is very, very large. And then, in fact, we further got into the business. And from there, I think your stock price has moved up 3 or 3.5 times or thereabouts. The opportunity, though, is something that the street is excited about. Valuations, you can argue that maybe the stock is not very cheap. But let's focus on the opportunity first. The Chinese medical devices exports, well, they are clocking around 75 to around $100 billion odd. India, I think, is at $4 to $5 billion. How do you see exports moving ahead with regard to the industry panning out? And also, Trump is coming into power in 2025. It's supposed to present an opportunity to India versus China. Tell us more.
So thank you, Nigel, for inviting me. Good morning to everyone. So I think, India, if you see 2-3 years ago, exports out of India were just around $2 billion. So in 3 years, we have seen it growing from $2 to $4 billion. And subsequently, the import growth has kind of deaccelerating. So there is a huge opportunity because of this PLI scheme which came in, regulations and, new medtech parks. So a lot of medtech manufacturing is now happening in the country. So as we speak, more than 3,000 medical device licenses have been given for companies to manufacture products in India since the industry was regulated. So it's a big uptake, in manufacturing in the country. And I see exports growing maybe around 15 to 20% CAGR for next 5 to 6 years because a lot of manufacturing has started, and I think there's going to be a ripple effect for local market as well as for export markets. Now, coming to the new administration in the US, I think, see, they will look at China very closely, and I think there's some tariffs coming on Chinese products already. Some have been announced, and some are going to come maybe in course of time. If India gets reciprocal tariffs, even if it comes, I think the custom duties in India is pretty low right now on import of medical devices. It's between 7.5 to 10%. So I don't think even if Indian products are taxed in US, it's not going to be very high. So I think we have a lot of potential going forward. We're already working very hard on this, getting more FDA approvals. We started working on this US business a couple of years ago. So I think now, we are seeing some, new contracts been thrown to us. So I think we are very bullish about US in coming years.
Okay.
And I'm pretty sure that more outsourcing will come to India in next few years.
Just to follow up then, from $4 billion approximately, as you said, we have doubled in the last 3 years. By 2028, should we be in that vicinity of around $10 to $12 billion for the industry? Is that a possibility? Point number one. And for you, Mr. Baid, I think in the coming year, you're guiding for $2 to $3 million of US revenues, right? But the opportunity is large. So in the similar time span, next 4 years, what should this number look like for you?
See, Nigel, if you remember, we talked last year about it, and I guided for $15-20 million initially. But I think now we are looking at a much larger number. Probably we could hit between $20-30 million. Looking at the new opportunities which we see in front of us right now. So definitely the number is going to change. But let's say next few months we are going to know more, have more clarity on that.
And the industry goes to 10 billion in the next 10 to 12 billion. Should that be a fair estimate?
I'm pretty bullish. I'm pretty bullish about it.
Got it.
Okay. Well, so lots and lots of room to grow, really, right? I mean, in that sense. Good morning, Mr. Baid. Prashant here. And Nigel, you were talking about the number of X's it's grown, right? I was just looking at the price chart. It's up 10 times in the last 4 years. 10x.
Phenomenal.
10 bagger, literally. So, Mr. Baid, so, yeah, I mean, opportunity is big. Since we're talking very basic, fundamental sort of, things here, let me ask you two very basic things. One is, an industry, medtech as an industry, for an outsider, it would seem like India is the big market, right? Because it's like import substitution. Because, most of the machine, I mean, you go to any hospital, most of the medtech, the equipment, at least the high-end equipment is all, I mean, either it's a Johnson or it's a Siemens or it's a what have you. So that's the technology part of it. Consumables, the gloves and the this and that, I mean, the syringes, all those, of course. I mean, I think but that's at the lower end. So just give us a sense. Is India the big market? What should investors really have their what should the focus be? How fast the Indian market is growing, or really, I mean, this export opportunity? Go on.
So if you look at Indian imports last year were around $8 billion across different categories of products. So in my view, this import is going to come down to maybe, let's say, next 4 or 5 years to around 4 to 5 billion. And that is going to be substituted by local manufacturing. And as we see, local manufacturing is already picking up. And plus, whoever is manufacturing locally, and if the technology is high end, let's say, in terms of manufacturing, I think the exports market open up simultaneously. And that's the reason. So there will be a double whammy impact, that imports will go down, exports will increase. So almost we will see $8 to $10 billion of new manufacturing happening in India and for export markets in the next 5 to 6 years. So that is where I see industry. And in fact, we have been discussing this with the government. And government is also pretty much, in tandem with the numbers we are talking about.
Okay. And this would be, I mean, the export part, right? Is largely to the developed market. Is that going to be I'm not talking about Polymedicure, but the medtech industry here, the Indian industry, not MNCs making here, but the Indian homegrown companies. Will that be on the consumable side, or will it? Do you see it moving higher end, high tech as well, technology driven, which are of course going to be higher value and margin accretive?
So basically, India is still at low to medium end of the technology. And I think when you look at India, India is not 1.4 billion people. And I think India is much more bigger market because Africa, Middle East, Southeast Asia, Latin America is all serviced by India now. And if we have similar, let's say, technology products coming out of India to those markets, I think that is a huge opportunity for Indian companies out there to address these markets. And other than that, of course, developed markets are there, Europe and US, which are going to take its own time. But these are, let's say, easy wins and sure wins, in near future. And I think India is still in the low to medium tech. But if you look at companies like, bigger companies like Siemens, GE, Philips, they have all set up manufacturing facilities in India. So all of them are now exporting out of India to at least 40, 50 countries. So that play area is also increasing in the high-tech space also.
Mr. Baid, hi. So now we've discussed the opportunity, we've discussed what India is doing, what the industry is doing. Let's come to specifics now. For Polymedicure, you've been guiding for about a 24% growth rate. Margins have been fairly healthy at 27%. You also, I think, mentioned on a recent analyst call that you're looking at technology tie-ups with perhaps larger global medtech brands. So where is that whole contract manufacturing opportunity? Where are you on those conversations? When should we expect something to come through? And an outlook on margins, whether you can improve them even higher from the current 27%.
See, I think we'll continue the guidance for 22 to 24% for rest of the year. So we are very, optimistic about that. You've already seen first 6 months, we have been close to that number already. And I think on the contract manufacturing side, I think things are, looking quite bullish right now. So we have been talking to a few players right now. And hopefully in the next few months, and I think the change in government in the US, I think the larger contract manufacturing opportunities out of the US right now. So I think as things, pan out in the US in the next few months, we will see a lot of action out there. So it's a wait and watch situation, but we are fully, aligned with that, and we are working on that. And we're looking also at other opportunities, whether we can, look at more technology outside of India and look at acquisition. So that is also another area we are focusing. But again, there's nothing concrete, but as soon as something comes up, definitely, we will let you know.
Okay, so just a quick follow-up to this. Two things. You said two things. One, that you should be announcing something on the contract manufacturing side in the next 2-3 months. It could be with a US company or a tie-up with a US company. Now, typically, how does it work? This obviously opens up a large revenue opportunity, but generally, is this business a slightly lower margin business, or does it retain the very high margin profile? Because you're at 27% now.
See, I think margin would depend on the product category, and definitely. So for us, we are not the cheapest manufacturer in the world. So definitely, that is very clear. So and we definitely would look at margins first also when we look at new opportunities. So I think we'll balance it out. So we are very clear that we'll continue to work on similar margin profile in coming years also.
Okay, Mr. Baid, very quickly before we let you go, last year you did around 1,400 crores and you're guiding for 20-25% growth. At peak levels, what kind of revenues can you do since you're doing some capex? And Mr. Baid, every time you join us, you tease us that there's going to be some inorganic growth. When? Before the end of this fiscal, will we hear something?
I'm not sure, Nigel, about the inorganic part, but definitely, see, it's always a work in progress. You continue to look at new opportunities, and you will have to look at it's always a build versus buy situation for Polymed, because we are a hardcore manufacturing company. So we'll have to look at that from a technology perspective, and we'll continue to look out. But on the growth side, Nigel, I think as we are doing some heavy capex in coming years, so the revenue will keep on. Of course, our target is to achieve a 20% growth over the next 3-4 years, and that's the number we will guide for in next coming years.
Mr. Baid, I was actually going to ask you why doesn't Polymedicure make for, say, a GE or a whatever, one of these larger medical equipment companies here? So when you say a contract manufacturing sort of tie up in the next couple of months, we should think on those lines?
So we are more on the consumable side, Prashant. So, for us, the play area is more consumable side. And that is also a very big part of the industry, whether it's in India, outside India, or in the US. So I think our focus area would be on the more on the consumable side.
And just one thing, that $8 billion market which you spoke about over the next 4-5 years, right?
Yeah.
How much of that value you think will be will come from Indian companies making in India, and how much from MNCs making in India?
I think I would say 50-50%.
Okay, about 4 billion from Indian homegrown companies, and the other from MNCs making out of India, but I mean, of course, selling here and elsewhere. Thank you very much. It's a great conversation, Mr. Baid. Appreciate you coming on and talking to us here. We'll speak again in the new one. Well, we'll take a quick commercial break here, and we're going to come back with the next company. So this is, a hotel company. Actually, I should say a developer, which is in the hospitality sort of business. We have Ashish Mota of Blackstone joining in for that conversation. Stay tuned.
Welcome back. Well, the markets have seen a good bounce from the day's low. We had highlighted this, right, earlier today, that don't rule out a bounce from the lows. Yes, the picture is looking very, very gloomy, and that's been the case, actually. So sustaining of this bounce is important. If I'm looking at a level, I think 24,120, that's the near-term technical resistance. The higher resistance will come at the 24,400, which incidentally is the 20 DMA. So keep an eye out on that. A good recovery, though, from the low point of the day. Let's address a few stocks, though, that are moving around. Sudarshan's here to revise what's going on with Exide and Amara Raja. Sudarshan, take it away.
So both the battery companies are higher in trade. Exide is currently higher by 2%, and Amara Raja is also trading with a gain of almost 1%. First, talking about the Exide company, in April 2024 had signed non-binding agreement with Hyundai and Kia to supply battery cells and battery packs. Now the update is company Exide has signed term sheet with Hyundai and Kia. And what does this term sheet do? Basically, it helps now Hyundai and Kia to onboard Exide as the supplier for both battery cells and battery packs. Now, this agreement is between Exide's electric mobility arm and Hyundai and Kia. And so far, Exide has invested more than rupees 3,000 crore in its electric mobility arm. Now, coming to Amara Raja, company will supply absorbent glass matte battery technology to Hyundai, and basically already company has the procurement agreement with Hyundai for the same technology, and Hyundai is likely to use this AGM technology for its upcoming electric vehicle, and that is likely to be, because company has not disclosed, but I assume it might be Creta EV, because that's the EV that Hyundai is looking to launch in Q4 of FY25. So that's the reason both Exide and Amara Raja are in focus.
Okay, all right, got it. Thank you very much for that, Sudarshan. By the way, look at the market. It seems Santa Claus is finally coming to town, or so the bulls would want to at least hope, because suddenly from about a 50-point dip at the open, now the market's up 81 points. That's quite a recovery. And it's cutting across sectoral lines: Titan, NTPC, Dr. Reddy's, Adani Enterprises, Bajaj Finance, Trent, Hero Moto, you name it. It's up and away.
Hopefully Santa stays in town, though. Hopefully there's an exit stage left, because we need to sustain at high levels. Just putting that point on board.
No, absolutely. And also, I think a lot of people have been hoping that finally these FPIs, they will finally go on their Christmas and New Year holiday, so they can at least stop selling. But we have to take that with a pinch of salt as well, because typically when volumes start thinning out, you can see outsized moves. But for what it's worth, it's a nice pullback by the market. The Bank Nifty now is the only main index which is in negative territory. Mid caps and large caps doing well otherwise. Markshi is with us. She's tracking a couple of other stocks that have actually held out nicely in positive territory. GE Vernova, I think, on orders, and BASF, which is spinning off a part of its business and looking to list it separately. Markshi, tell us more.
Well, absolutely, Surabhi. First up, GE Vernova, the stock will be in focus, and that is because they've announced a few order wins. They've received orders worth over 400 crores from Sterile Grid for supply of high voltage equipment, and some analysts estimate that the company is sitting on a backlog of almost 10,000 crores, and this backlog has come in despite winning no HVDC orders. So that's a big positive for this company. They've also won some orders in the past as well, and therefore you're seeing that up move on this counter. But apart from that, BASF BASF is the next counter we're watching out for, and that is because the company has announced that the board has given its in-principle approval for demerger of its agriculture solutions business into a separate listed legal entity. Now, this in turn will enable operational flexibility, leverage differentiated steering, and create value for the shareholders of the company. Keep in mind that this particular part of the business accounted for nearly 14.5% of the FY24 revenues at 2006 crores, and this move is in line with what the company had announced back in September. Back then, they had said that globally BASF SE will complete legal and ERP separation of Agri Solutions business by 2027. So this is a step in that direction, and therefore the stock is seeing an up move today.
Okay, all right. Vamakshi, thanks very much for putting that on our radar as well. So BASF doing really well in trade today. But it is the primary market that's been dominating the attention, and you've been hearing us, of course, get into a lot of conversations to understand these new businesses which are coming to the street. So let's get another one going. Ventive Hospitality's 1,600 crore rupee IPO is opening out today. The price band is 610 to 643 rupees a share, and the company is going to be using a large part of this fundraise, almost 1,400 crores, to repay debt. Ashish Mota, Managing Director and Head of the Real Estate Acquisition at Blackstone, backed by Ventive Hospitality, is with us now. Ashish, great to have you on. Thanks for joining in. And I must tell you, this is a breath of fresh air, because usually I think 80% of the IPOs, if not more, that are coming to the market are all OFSs, right? But you are actually raising the cash. It will go for the use of the company. And a large part of this is going to be for retiring debt. So let's start there. How much debt will you be left with? I think you have a little over 3,000 crores on the books. What is the debt equity level that you're comfortable with? And once you pay off this debt, how much will your finance cost go down by? And what is your borrowing rate? I'm just curious. At what rates do you borrow right now?
No, thanks, Urbi, and good morning. Honestly, we're using, like you said, most of our proceeds to deleverage at post paying down the debt. We will be less than 10% LTVs. Our debt cost should be in the zip code of about 100 to 120 crores. Average interest cost being about 9% So the idea is, honestly, to use all of these excess proceeds, the capital structure flexibility that we'll build in, to acquire assets, to grow our balance sheet both organically and inorganically. So that's the idea about future growth for Ventive.
Okay, but so while you're paring down all this debt, you're also adding capacity. You'll be moving from, I think, about 2,030 odd keys to, I think, a little over 2,400. That's your target over the next couple of years. So how is, have you accounted for the funding for this? And just give us a sense of the revenue as well as you keep adding more and more rooms.
So honestly, today Ventive is already cash positive. We have about close to 900 crores of EBITDA, translates to a large amount of cash. And the idea is to fund the current pipeline, which is about 370 keys, entirely through internal proceeds. So, we will not use or we will not need any external debt to finance the existing pipeline of assets that we have.
Ashish, hi, good morning. Prashant here. Would Blackstone sort of be in the company over the next couple of years, at least 4 or 5 years?
Yes. Yes, Prashant, clearly. So, honestly, we are very excited about the hospitality sector, both globally and in India as well. And the idea is to benefit from the growth that we can see over the next few years. So, as you see, neither Panchsheel nor us is selling anything at the IPO, and the idea is to continue to remain and see some of this growth over the next few years.
So, no sales for 3 years, 4 years, at least?
I wouldn't say that. We are fund structures and we will sell down, over time. But I think we believe in the long-term potential of the platform. And, we'll continue to sort of invest more capital, invest into new hotels to sort of grow this. And therefore, we think we'll be here for the longer term.
So out of those 2,000 odd keys, it's largely split between, the majority is, I think, Maldives, right? And the rest is...
Pune and Bangalore.
It's actually 1,500. It's about 1,500 keys in India, Prashant. It's about 500 keys in the Maldives. The idea about Ventive, honestly, was to target the aspiring Indian business and leisure traveler. So I think that's the segments that we're sort of focused on. We are focused on the upper upscale and luxury segments, where we think we'll derive the most profitability. And therefore, we will continue to sort of grow and expand in these. If you look at the development pipeline that we have, Varanasi, again, a big tourist hotspot. Spiritual tourism is sort of catching on in a big way. I think that's why we are building a Marriott. We are focused on the key office markets. Bangalore is something that we're expanding on. Pune, we have a large presence, and we'll continue to grow in some of these markets going forward.
Ashish, just one thing. So the company is a developer, right? And then you get on these, the JW and the Ritz, etc., to manage the hotels. So the company pays a fee.
Correct.
That is in what vicinity and how will that?
Prashant, it's broadly about 6% of top line. That's the zip code on which, and just given the scale that we operate on, we typically tend to get the better end of some of these contracts as compared to standalone operators. So, Marriott's a large partner with us, but, we are pretty brand agnostic. We have Hilton, Raya, Minor, most of these guys as partners on some of our hotel properties.
Just want to tell you, Nigel, I had the good fortune on a business trip of staying at the Ritz-Carlton, Pune. I would have to say, one of the best experiences that I've had. So Ashish, please pass on my compliments to the team. Absolutely fabulous. And I think that is the class that you're targeting, right? The business traveler, aspirational leisure. So yeah.
Absolutely.
Just thought I'll put that on the table.
Bang on.
Indeed, Ashish, we've been happy travelers, happy customers. So that's great news. And thanks a lot for that, for playing a role in that. But the big question is going to be, what about the shareholders? So let's get back to that then. You're going to be retiring close to around 1,400 crores of debt. You'll save close to around 200 crores of interest, as you told us earlier. What is the balance sheet going to look like post that, post this debt repayment? Will you still have some debt? If yes, how much would it be? And since there's going to be a swing of 200 crores, now you'll turn PAT positive, right?
Yeah, so a couple of things on that. Our debt will go down to about 1,500 crores. We have about 3,000 crores of net debt today. It'll go down to 1,500 crores. In doing that, we'll release a lot of capacity for us to grow. So I think that's our key focus, to continue to sort of grow this platform going forward. And that's what we see in terms of the capital structure.
Okay. So, just to talk about some levels, if you can kind of leave us with the occupancy for the first half, I think was about 61% odd. The average room rate is about 16,645. Just kind of a bit of a peek into the future, because anyway, the second half is very, very strong. This quarter is very, very strong for the industry as a whole. But the ARRs that we see, you yourself were touching, I think, close to 20,000, right? This is as of FY24. Do you see these levels of 20,000 sustainable? And, as you yourself glance into the next calendar year and the next fiscal year, what do you see on occupancies and ARRs across your properties?
So, without getting into the specifics in terms of, numbers and projections, but just, you said it right, Ravi. I think the second half is obviously very good in the entire hospitality sector, but it's also, fairly skewed in the Maldives. So, the last 6 months of the year typically get about 70 to 75% of the revenue in. So we expect a very strong third and fourth quarter, both across India and the Maldives. Just to give you a sense, in terms of ARR breakups, we are at about close to about 11,000 rupees in India, about 70,000 or about $850 in the Maldives. And we dominate, both the peer sets in India and in the Maldives across our properties. So what we're seeing in terms of bookings, very strong across both India and Maldives. So we expect both occupancies and ARRs to sort of keep ticking up.
Got that. By the way, Ashish, we speak with hotel companies all the time, and we had the Sami Hotels Management. We speak with Indian Hotels Management quite regularly, and generally, the expectation is that the cycle is going to be on and is going to remain good because of supply-demand dynamics. Being favorable over the next many years. So I think you're in a good place. Thank you very much for joining us, and looking forward to many more conversations as the company makes it to the market.
Thanks for the time.
Thank you very much. Okay, all right. That's the new hotel company, which is, the issue is opening today. So another very interesting company, and this is a MNC that we're talking about, but in the auto ancillary space, Carraro India is open for public subscription today. It's an Italian company. It's a 100% owned sort of MNC, and it's a complete OFS by Carraro International, the Italian entity, in the Indian entity. They've raised about 375 crores from the anchor investors already. We have David Grossi, Chief Financial Officer and Whole-Time Director, and Balaji Gopalan, Managing Director at Kararo India, are joining in to take some questions. Gentlemen, great to have both of you here. Thank you very much for your time. Prashant, this side. Balaji, if I can start with you, the money that is being raised, I mean, first up, a basic question, what is it going to be it's a complete OFS, so it goes to the parent, right? What's the basic underlying motivation to do this? It's an Italian MNC making it to the Indian bourses. First thoughts, Balaji.
Yes, thank you very much. Very good morning to all of you. Thank you for giving us this opportunity. We are very excited about what is going to happen now. It's a new chapter in the history and legacy of Kararo Group and Kararo India. We will be the first country or the subsidiary of Kararo Group to get listed outside Italy, and it's a very proud moment for us. And we are very thankful to the Indian market and the environment here, which is encouraging the shareholders to look at India in a big way. The reason why we are going in for this IPO is Kararo is a technology company. We provide differentiated solutions for the transmission industry in agriculture and construction vehicles. And we have consolidated ourselves in the last 3 decades, and we are seeing a very clear movement that is happening from the two-wheel drive technology to a higher technology in tractors and introduction of specialized vehicles in the construction sector. And this is where Kararo has the legacy of 90 years of presence in global geographies and aware of the global soil conditions. So we are able to provide our OEMs, our customers, with the right product solution and the right technology that is required in India, mainly in agriculture, because food security has become a big
Balaji,
concern.
if I can, allow me to come in. No, that's very well put. I mean, just a basic introduction. So let's just talk about tractors, right? Which is the primary, the big sort of revenue stream for you. And as you said, you're in the four-wheel segment within tractors.
Yes.
Just break it down for our viewers. The market size right now. How many tractors? I think a little over 10 lakh tractors are sold every year in the country.
Yes.
How many are four-wheel, which is where you are operating in?
Yes.
How fast is that segment growing? As a percentage of the cost of the tractor, the transmission that you provide, the transmission gear that you provide, what is that in value terms? And how is that growing? Go on.
Got it. So as you rightly pointed out, the Indian tractor market is roughly 1 million, 10 lakhs. And today, the penetration of or the migration from two-wheel drive to four-wheel drive has reached roughly between 16 to 18% as per market research. And this growth absorption is happening quite fast, I would say, because if we take a data of about 6 years back, it would hardly be 2-3%. So in the last 5 years or so, there has been an uptake and absorption of this four-wheel drive technology. And what is more important for all the investors and for you as well is to understand that globally in developed countries like US and European Union, the four-wheel drive market is upward of 96-97%. So India is still at a very latent stage in absorbing this, and we have a long way to go. And to answer your question specifically, currently the four-wheel drive market has reached roughly about 17%, number one. Okay. Number two, your question about what is the
value.
The differential, I think, in the pricing is what you were asking.
The value.
Two-wheel drive.
No. The value. In the four-wheel segment, how much does a tractor cost, and what is the value that you provide? I mean, the kit, the transmission gear.
We are a mission-critical supplier because our products which go into the tractor constitute between 20 to 30% of the cost of the vehicle. So if you take a 10 lakh rupee tractor, which is roughly a 50 horsepower tractor, a four-wheel drive versus a two-wheel drive, the differential should be between anywhere around 70,000 to 90,000, 95,000, depending on which configuration of the four-wheel drive you will be using. So that is the price range that is the differential between two-wheel drive and four-wheel drive.
All right. Hi, gentlemen. Good morning and good to see you, Vin. This is Nigel on this side. Since it's an entire OFS, I'll want to understand what is the current capacity utilization levels you're functioning at. I think you're doing roughly around 1,800 crores of revenues. So what is the utilization levels? What is the debt in your books? And how do you all fund the further expansion from here on? 3 numbers.
Okay. Coming first to the utilization, our plant utilization currently is between 82 to 85%, considering the gear plant and our assembly plant. And in an industry that we are working on, this kind of capacity is sufficient to cater to our needs, because we need to also keep a buffer. So I would say we are more or less quite well utilized and quite efficient in our operations, and any further increase in our revenues will require some amount of investment to happen.
Okay, all right.
Pertaining to the financial aspect, I would double click on David Gulick to kind of, David Grossi to please come in.
Coming across to you, David, take it.
Yeah, of course. So in terms of debt, today we have a net financial position of roughly 100 crores, 10 to 12 million euro, and a debt equity ratio which is lower than 0.5x. So we believe a level of debt which is
okay, all right. So we got that 100 crores odd is what
future growth.
Yeah.
Sorry?
Yeah, please go ahead. The line just snapped there. Please go ahead.
Okay. In terms of future growth, future expansion, according to our plans, whatever will come in the future as of now is manageable with our internal accruals, with our internal cash flow generation. So we do not see, we didn't see any need to, maintain part of the proceeds here in India.
So this is 100 crores of net debt as of now. You're functioning at around 82% capacity utilization levels. Just one more point I wanted to understand. What is the asset turn for y'all? If you'll put in 100 crores, how much of revenues can you generate?
Usually twice as much.
Twice. Got it. And just one more question. Since it's you have an international parent, as of now, I understand there is no royalty that is paid. Is that correct?
We pay a small royalty, which is for the brand utilization.
Okay, what is that amount, sir?
We pay a small royalty to our parents for utilization of the Carraro name. It's a brand royalty.
Okay, what is the percentage? The current percentage? What percent of revenues do you all pay as royalty?
I think there is a line disconnect between you and
Balaji, why don't you take it?
Yeah.
What's the royalty percentage?
There are 2 royalties. One is the product royalty, engineering royalty, which is 0, because they have transferred 153 IPs already into Carraro India. Hence, we don't have to pay any royalty for the product. However, in the past and in the present and future as well, we have to pay a small brand royalty, which is roughly between 0.3% to 0.4%.
Okay, and on this product royalty, which is 0, earlier there was an amount, but currently it is 0. Any plans of restarting the product royalty, or it will not come back? Because post-listing, your shareholders will want to understand what is the vision with regard to this royalty. So any plans on restarting the product royalty, and on the brand royalty, will it stay in this vicinity of around 0.3%, or is there an upside risk?
No, first of all, answering the brand royalty, which is applicable, it will remain in that zone. We have never gone beyond that decimal of 0.3 or 0.4, and it will continue. Historically, it has been the same. Now, coming to the other question of whether the product royalty, engineering royalty can kick in again and there is a reversal, I would like to assure you, not just as an assurance, but the very fact that 153 IPs have already been transferred and bought by Carraro India, there is no question of paying any royalty to anybody, because the IP is now owned by Carraro India.
Got it. All right, now got that. David, just one last question to you. So the the parent is selling shares to Indian investors. Will this be it for now, or should we expect more sales, or no plans as of now?
As of now, no plan. This is the range of dilution that we were planning. But of course, now we are diluting around 30%, which means that we keep a door open for the future. Never say never. But as of now, this is not the plan.
Okay, that sounded like you said keep the door open, but no immediate plans. Nothing has been discussed.
No.
In any case, let me come in here. It's important to understand that Carraro is a global company and it wants to penetrate into India and make India one of the largest operations of Carraro Group. So keeping that in mind, we have strengthened our operations over here. So the concept of dilution is not there in the horizon as of now. But what Mr. Davide meant was you can't say no to something, but it's just a hypothetical situation that something can happen in future. But as of now, in the next couple of years in the business plan, we have no such plans of getting into further dilution in the market.
All right, Ms. Balaji,
we will
thank you very much.
Consolidate and grow. Yeah.
Thank you very much for joining us, Balaji. David, thank you very much for joining us. A great chat. We had more questions, but out of time, and we'll continue and pick up on this when you make it to the market in terms of the listing itself. So the IPO, of course, opening today. So that's the primary market action. But look at the secondary market.
All over the
place.
place.
There is a dive and how. At 9:42, the Nifty was at about 24,054. And now we're at 23,812. 810. So we're at the day's lowest point. That 100 point now seems like a flash in the pan is gone. And you're essentially where the GIFT Nifty was indicating the open about 100 odd points down at this point.
And Prashant, this is also the point that now we're at that zone of testing the 200 DMA. To be fair, the Nifty in the earlier part of the correction has dipped below the 200 DMA, but then it managed to recover from there. When I'm just going to go back for the sake of reference and talk about those lows, we're still far, far from them. These are the lows in November that I'm talking about, late November. The low at that point was 23,263. Thereabouts.
That's a support survey.
So, so we were still a distance from those levels, but the sell-off has been quite furious and has been very, very choppy. In fact, after the break, I think we'll have Mitesh join back in and take us through some of the ideas. Just want to point out that the Bank Nifty is leading the decline. It's down about a whole 1% at this point in time. And mid-caps, they've also now given up. Mid-caps for the better part of this week have managed to continue moving higher, irrespective of the large-cap move. But now the advanced decline ratio is negative, and the mid-cap index is also down 0.6%. More on the markets in just a bit. Welcome back. The next company on our radar is JSW Infra. Now, the stock has been a good performer in this year, 2024, up almost 50%. The company recently announced its longer-term, medium-term vision in terms of how much capacity they're looking to add, what their plans are. In fact, their capex is going to be 30,000 crores from FY25 all the way up to FY30. So let's talk about this vision in some more detail. We have Lalit Singhvi, Chief Financial Officer at JSW Infra, joining in. Mr. Singhvi, great to have you on. Season's greetings to you. So let's start right there with this guidance that you've given that your cargo handling capacity is going to be 400, MTPA by FY30, and you'll be putting 30,000 crore rupees to work in this expansion. How will you fund it? What are the current debt and cash levels? And what's the plan?
Good morning, and first, thank you for having me on your shows. So this expansion plan, what we have announced is, taking our capacity from 170 millions to 400 million tons, and this will entail 30,000 crores of rupees. So as far as funding is concerned, we have a very robust operating cash flows. So if you see our cash flows last year was also 1,800 crores rupees, and next 6 years, and a lot of capacity additions will keep coming up every year. So with this cash flows, and there will be one equity dilution also. as per the regulator's requirement, we have to dilute our equity from 85.6% to 75%, and that has to happen, before October 26. So that is going to happen, and balance sheet is very robust. Right now, till September, you can see that we are net debt free. So partly we will need debt in between. So with these all three, combination of sources, we are very comfortable to fund our growth plans.
So, sir, just let me dive a little deeper in the mix that you pointed out. You said you're generating 1,800 crores of cash. The business is throwing up that kind of cash annually. You will also need to sell some equity because of regulatory reasons. So let's discuss that first, and then we'll get to the borrowings. So you need to lower, the promoters will have to lower the stake by almost, roughly 9% odd. How much will anything happen in FY25? Yeah. How much in FY26? And where are the plans with respect to this equity placement?
Yeah, so, going by the, during IPO also promoters have not, sold their shares. So it is more likely to be a primary issuance. So money will come into the company. And right now we don't need money because we are sitting on cash. So we will be doing probably, before the regulator's deadline. So immediately we don't need to fund that. And if you do the back calculation for bringing 85.6 to 75, we need to dilute 14% of the current base. So it's quite a big chunk, and there is a very good appetite from the investors because right now the floating stock is low. So we will decide whether to go in one stroke only, the entire thing, just before the timelines, because currently we don't need any requirement.
Mr. Singhvi, hi, good morning. Prashant here. One of the things I've heard from investors, and this is, investors and analysts who track the companies, that, you're in a space, JSW is a very large group, a conglomerate, but you also have a competitor which is very large and which is kind of, at least on the port side, has some of the best assets which are already taken. You, of course, you're more on the terminal side, not so much on ports and greenfield ports, etc. So I just wanted you to respond to that. And out of this you will go from 170 to 400, right? This 230 million tons that you will add, how much of this is going to be fresh acquisitions in terms of what you modeled, and how much will be increasing capacity of assets you already have?
Sure. So, say from 170 to 400, which is 230 million tons. So, out of that, 50 million tons would be the brownfield. So, we have our ports like Dharamtar, Jaigarh, and Goa and Mangalore terminal. There we are adding the capacities. So, around 50 million tons would be the brownfield capacity additions, and 130 million tons would be from greenfield. So this greenfield includes, we have already announced, one is Murbe, which is very near to Mumbai. Another is Keni, which is in Karnataka. And the third one is Jatadhar, which is Odisha. So there are large projects coming in, all put together close to 100 million tons of capacity we are adding. And the remaining 50 million tons is, is in the pipeline. So we will be announcing as and when, we have approvals in place. So this is the total 400 million tons. And, our business model, if you compare with others, they may be largely on the private side, but we find, the combination of terminals and greenfield ports, which are the private ports, that works well for us. Because in case of terminals, CapExes are low because all the ecosystem is provided by the port trust, like dredging and, breakwater, evacuation system. So CapExes are very low, turnaround is very fast. So I look at it like ROC. So ROC from the terminal comes much better. So if you look at our ROC versus the greenfield heavy ports, you will see the difference.
Yeah, no, absolutely. And I remember having this conversation during the time of the IPO as well. So out of the 230 addition by FY30, sorry, you said brownfield is 50, rest is greenfield. Everything is greenfield. Is that, did I get the numbers right?
Yeah. So 50 is the brownfield, rest everything would be greenfield. Yes.
rest everything will be a green field. Got it. And any inorganic, sort of further inorganic acquisition, etc., we should hear from you in 2025?
So, this 400 tons doesn't include what we, bid through the, in the privatization process of the government. Like last year, we won 2 bids. One is in JNPT, another in Tuticorin. So government keep coming up with the, privatization process and few terminals every year it's coming. So there we will be bidding aggressively. But that quantity we cannot share now because we don't know how much quantity will come and how much we will be able to win. But we stand to a very good chance, as you know that there are only 2 pan-India basis players and one is not very keen on the terminal side, as you just said. So we stand a very good chance to win those things. So as and when it comes, there are 2-3 in pipeline we are hearing. But as and when it comes, we'll be bidding it aggressively and add to this, and this will be on top of 400 million tons.
Mr. Singhvi, just a quick final question, just to go back on the capex. You said that there will be some element of debt that you will take on. What is the debt equity that you are that you will be comfortable holding to fund this 30,000 crores?
We have given guidance in terms of net debt to EBITDA, which is 2.5. But we don't foresee that we will be touching anytime soon that 2.5 thing, because our cash flows will remain robust, and by 27-28, 118 million ton capacity will come into force, effect, and that will be giving again cash flows. So, but that is the guidance. What we have given is 2.5.
All right, got that. Thank you very much, Mr. Singhvi, for joining us and sharing all those details with us, with our viewers. Really appreciate it. And we are wishing you and your team a very good 2025 as well. Always good speaking with you here on the channel. I think we're going to take a quick commercial break here. Market's down 40 points, so there is a recovery. From the last time we saw, there is a 100-point recovery, which is already set in. So very volatile. See you on the other side.
Welcome back. Here with us on Bazaar, and what we are looking at is a very, very volatile equity market. From a big fall of almost 140 points, now there's a bit of a recovery, back almost in the green, again in the red. Extremely choppy day on equities. But what's happening with commodities? Let's go across to Manisha and find out. Manisha, happy Friday to you. What's the latest?
Well, I'm looking at the iron ore prices, which are headed for negative 2024. If you look at the prices in China, they have declined by 21%, and the US prices are down by almost 23% at this point in time. If you look at the chart or the report card for 2024, well, we started the year on a higher note at $144 a ton. We did see a decline at around $90 a ton as well. Currently, the iron ore prices are holding it out at 104. Well, there have been various reasons for the decline in prices. The major one comes in from steel, which also has seen a price decline. And because iron ore is a major ingredient in steel, and the demand was lower from China because of the construction sector going down, and the steel prices declining 17% in China and down by 38% for HRC in US, that led to decline in iron ore as well. Apart from that, it also is about the ongoing economic uncertainty when it comes to demand. There is lack of detailed policy from China in sense of fiscal spending for 2025. The markets also are looking at China on whether or not we would see better numbers coming in, because China is the largest consumer when it comes to iron ore. There also is higher production numbers coming in from major producers like BHP, Vale, Fortescue, and of course Rio Tinto. So we are looking at higher supplies, higher inventories, and that has led to pressure coming for prices. The markets also have seen increase in exports from Brazil and Australia. That has been weighing on as well. So 2025 pretty much could be a surplus year when it comes to iron ore there. The output has been increasing and the worsening demand, and that is what is weighing on. Talk about the outlook for 2025, and most of the banks and brokerages are talking about lower prices here. The best of the numbers, that is $100, comes in from BMI Fitch, but other banks like Bank of America, Goldman Sachs and ING are talking about prices anywhere between 80 to 95 on the lower side from this year for 2025.
All right, Manisha, thank you very much for that. Keep a close eye on those commodities. Markets are volatile. We're down just 40 points, but I have to say market breadth is firmly down, 2:1 in favor of the number of stocks which are declining. It's goodbye from all of us here on Bazaar. Thank you very much for staying with us. More coming up on the other side.